Well, where do we start? There's a lot going on at the moment. Let's go and find what Martin Crabb from Shaw and Partners has been keeping an eye on today, apart from the soggy weather outside. Martin, good to go and see you.
Good to see you too.
Can we go and start off with the geopolitics, because that seems to be dominating everything for the time being.
Yeah.
As an investor, what do you do in a situation like this?
Yeah, hide. Yeah, so this is one of these tail risks. It's out there. It's like the South China Sea, Taiwan, Hong Kong. Another variant of coronavirus. These are things might happen, but it's very difficult to know what to do in a portfolio setting. So the obvious thing here is A, risk off, so own lots of cash, sell a few stocks, put a bit of money on the side, wait till things settle down. Secondly is say, well, okay, if we do get a Russian invasion, which looks increasingly likely, the price of oil is going to go through the roof, right? We're going to go straight through $100. We're probably going to go there anyway. Let's make sure that my portfolio's got a decent weighting to oil and maybe gold as well, because in a risk-off environment, the market just runs towards US dollars, treasuries, and gold. So we've been saying this for a while. To always have some gold in your portfolio as the airbag for the crash that might happen that you just can't see, such as Ukraine. And obviously, energy is both the poison and the cure for everything that's wrong in the world, right? So it's the cause of all the inflation. It's the cause that the central bank's having to normalise policy. It's destroying your portfolio. So make sure you've got some as the cure, if you like.
Mm-hmm. Well, you have, to your credit, been talking about gold and energy for quite some time.
Yeah.
But if you were inclined to sell, where would you be lightening?
Good question. The obvious downside remains high PE growth stocks, because obviously the flip side again of oil is it's a tax on world growth. So $100 oil is probably something like 8 or 9% of global GDP is going to be spent on energy. That's the tax on growth. So we will see slower growth. So do we have stocks where the business model's got a little bit of a question mark next to it? It's on a nosebleed PE, and we've probably made 100, 200% on it last year. It's all the stuff that Cathy Woods owns, right? So anything in her portfolio. She's down 75% already. So in our market, it's buy now, pay later stocks. And you mentioned Zip earlier, sub $2 now. That was $12 a year ago, I think.
It's incredible.
It may be too late for selling some of those stocks, but in the high PE, Zero, Next DC, Altium's another stock that's been under pressure. We actually like Altium, but that's a stock I think that people have been looking to say, look, it's on a big PE. It's going to take years to justify that. I'll just take some money off the table. So I still think that's the trade that's going on at the moment, likely to continue for a while.
Hub24 was one of the companies we had up there on the boards before. It went and released results today. 4% gain. Pretty good, particularly when you look at some of the rivals in the space have not fared as well. What did you take away?
Yeah, I had a quick listen to Andrew talk on your show earlier, and he said obviously the Class acquisition's gone well, and they're still taking share. Them and Netwealth are still taking share from the incumbent platforms. But I think what the market liked is margin expansion. So Netwealth was down 10% the other day because their margins were down. So everyone's been talking about price competition in that sector anyway, because it's a bit like funds management, Scuddy. Managing 100 million or managing 100 billion, it's kind of the same cost. So your marginal revenue is massive. I think the gross margin for Hub is something like 83%. So every extra dollar they get on the platform, so they start competing with each other once they reach that level of profitability. But Hub's result actually showed margin expansion, despite the fact they've taken on Class, despite the fact they've grown their headcount by 40%. Or I think it was maybe 20%, 80 heads they've added. So a big increase in their cost structure, but their revenue's growing at like 80. And they also guided 2024 FUM, which was above certainly what we were going for. And they'll be at 100 billion in 24-25, which is pretty amazing for a company that's only a few years old. But it's a bit of a no-brainer because the incumbent platforms are losing money. The old bank-owned platforms are losing money. And Hub, Netwealth, and to a lesser extent Praemium are picking it up. So it's difficult not to see this company continuing to grow.
Another report out today, Coles, it beat expectations, which is no small feat, in this environment with all of the rising COVID costs, with competition on price. But then we did have the lockdowns, acting as a bit of a tailwind. So how do you read, importantly, these big grocery names going forward?
Yeah, so they fit in my head into the pricing power bucket. So theoretically, Coles and Woolies control so much of the supermarket space in Australia that they really control the pricing outcome for customers. So it was interesting, Woolies the other day got knocked around because they said, look, we've got all this cost price inflation we're having to hold our prices down to keep volumes up. We really want to attract shoppers, so we're not passing on all the costs. So they're wearing a bit in their margins. So people were looking for that in Coles' result today too, but their margins actually went up by 5 bips in their supermarkets business. And that was interesting. So they've decided, look, we've got pricing power, we're going to exercise it. We've got all this raw material, like price of meat's so expensive right now that they've decided to pass all that on to customers and actually grew their margins. So the market kind of looked at that and said, they're not like Woolies, they're not eating some of this cost pressure in their margin, they're actually passing it on to consumers. So that's a very good story. So you'll see people upgrade their Coles numbers. We still think it's too expensive. It's still, at the end of the day, a low growth stock. Why it's trading on 24, 25 times earnings beyond me. So I wouldn't own it here, but I think it's starting to look a little bit more attractive than it was.
Okay.
Looking ahead, we're over halfway. Still a lot on the radar. Any stocks or any names you're looking after in particular in the next couple of days?
Yeah, not so much. I try to look at the big picture stuff. I've been pleasantly surprised so far. I think there's been more beats than misses. I think a lot of that's due to iron ore being higher, lithium being higher, and energy being higher. I think if you strip that out, it's probably a little bit more neutral. But yeah, I mean, results have been, everyone's getting super bearish on the market. I mean, the Nikkei was down 3% today. NASDAQ futures are down 2.5%. You know, we're going to open really ugly tonight. Everyone's getting bearish all of a sudden. I'm sitting here with cash going, I'm just looking for things to buy. So, you know, I'm looking at some optimism in the market, not all the pessimism right now. So, yeah, I've been pleasantly surprised by profitability. Corporate profitability in Australia is pretty good, and savings are very high, and people are coming out of lockdown. So I'm not that too pessimistic on the outlook for the rest of the reporting season. We always know, Scotty, that we get the cockroaches at the end, right? The last couple of days of reporting season, there's always the company that doesn't want to tell the story that eventually has to. So we've got to look out for those.
All right, a few pranks on the way maybe.
Yeah, but dividends and buybacks have been a feature of this reporting season as well. But you talk about people focusing on, the glass half empty rather than the glass half full. You're still overly optimistic to the degree that you think that we'll see this market rise. I mean, it's stubborn, isn't it? It's at 7,142 at the index level. Or again, is it very much finding those threads and those themes and those specific companies within? Yeah,
I think the market's just trying to build too much of a bearish narrative. It's got the Fed tightening aggressively, it's got inflation out of control, it's got growth slowing down, it's got supply costs that can't get passed on to customers, and it's got a war. And it's got all those things happening at the same time. They won't. If we have a war, the central banks aren't going to be as aggressive. We're not going to have the inflation, et cetera, et cetera. So I think you can tie yourself up in knots and build too much narrative. You made a really interesting point, which is just cash. There's $1 trillion in excess cash in Australian households. There's only 24 million of us. That's a lot of cash. And then you've got BHP's effectively giving back 20% of its capital in either dividends or the Woodside, and all of that's fully franked. Yeah. But then the bank's doing multi-billion-dollar buybacks. You've got industrial companies have got ungeared balance sheets, they're doing buybacks, so there's so much cash, and that's on top of a 4% mostly fully franked dividend yield. So it's kind of hard to get too negative right now. Yeah. And when you go and have a look at I was looking at some of the property data at month to date for CoreLogic and the like, and Sydney and Melbourne house prices as well are also starting to go and stall at the moment. So when it comes to places to go and put your cash and allocate, maybe equity market could be better than most. Yeah. Well, and I also think, to your point about sometimes getting all tied up in a knot, I had a chat with Ryan Stokes from Seven today, and he's saying, yes, there is inflation, but that's good because he's happy to deal with a bit of inflation because it means that demand is really strong, and there's good economic growth. That's echoes of BHP as well, and the ability to grow margins and pass on these prices. So he's quite positive with the outlook. You've got lots of construction going on, lots of infrastructure spending as well, energy. What do you think of Seven Group, by the way? Yeah, I mean, it's not one the market really focuses on because it's just considered as Kerry Stokes' plaything. And it's not in the ASX 100, and its free float's not that large. So even though it's like a $7 or $8 billion company, it just doesn't register as strongly with investors as it should. And it's always been a bit of a weird grab bag of assets. I mean, what actually you're buying? Is it Caterpillar? Is it Seven West Media? Is it Boral? Is it Beach Energy? Is it a TV station? Is it some newspapers? what is it actually? So markets have always struggled with it from that perspective, and then you've got what are the Stokes family going to do next? What's their next investment idea? So it doesn't really get the attention that it should, despite it being a very successful business.
Well, I tried to figure out what he was going to invest in next, and I didn't quite get there in the end. more of the same, I think.
Yeah.
Martin, always fantastic going round off a Tuesday with you.
Talk, guys.
See ya.
Yeah,
Stay
take care.
dry.